Imagine a film that rakes in hundreds of millions at the box office, becomes a global sensation, and spawns countless sequels and merchandise. You'd assume its creators and everyone involved would be swimming in profits, right? Well, in the labyrinthine world of Hollywood, that's often far from the truth. Behind the glittering facade of premieres and blockbuster success lies a shadowy financial practice known as Hollywood accounting, a system so ingenious, or perhaps nefarious, that it can make even the most colossal hits appear to lose money on paper. This isn't just about creative accounting, it's a deeply entrenched mechanism that has shaped careers, stifled artists, and generated untold controversies for decades. From legendary directors to iconic actors and even the studios themselves, nearly everyone has a story about a massive success that, financially, was declared a flop. Today, we're pulling back the curtain on this intricate web, delving into the leaked documents that reveal the staggering extent of how studios manipulate numbers, turning massive profits into phantom losses, and why this system persists. Before we dive deeper into the astonishing revelations, please take a moment to subscribe to the channel and give this video a like. Your support helps us bring more investigative content like this to light. The core of Hollywood accounting hinges on a simple yet devastating principle: profit participation. Many creatives, from screenwriters to directors and stars, often negotiate contracts that include a percentage of the film's net profits. The catch? Net profits are frequently defined in such a convoluted way that they rarely materialize. Studios, masters of crafting intricate financial statements, employ a range of tactics to ensure a film's expenses perpetually outweigh its revenues, at least on paper. These tactics include charging exorbitant distribution fees, a fixed percentage of gross revenue, regardless of actual cost. This built-in mechanism siphons off revenue before it ever reaches the net profit stage. Then there are the notorious overhead fees. Studios routinely charge a percentage of a film's budget, sometimes as high as 15 to 20%, for general administrative costs, executive salaries, and other operational expenses. These are costs often already covered by the studio's overall operations, yet they are allocated directly to individual film projects, inflating perceived expenses and effectively double-dipping into film budgets. This practice alone can turn a healthy gross profit into a paper loss, especially for films with massive budgets. Global marketing and advertising costs, while crucial, are often front-loaded and strategically assigned. Studios might attribute the cost of promoting an entire slate of films to one blockbuster, burying its potential net profit under shared marketing debt. These costs, while real, can be inflated or strategically assigned to ensure that the net profit line remains elusive. Furthermore, studios frequently engage in intercompany transactions. If a studio owns a post-production house or a visual effects company, it can charge itself, and thus the film, inflated rates for using these in-house services. This practice keeps the money within the larger corporate umbrella but ensures the film's individual balance sheet shows higher expenses, reducing its net profit. It's a closed-loop system designed to benefit the parent company, rather than the individual project or its profit participants. The consequences of this system are profound. Many artists, despite creating wildly successful films, have seen little to no back-end compensation, often receiving a base salary but never a penny from promised net profits. This has led to numerous high-profile lawsuits, with creatives challenging studios over their accounting practices. The studios, of course, defend these practices, arguing they bear the immense financial risk of producing and distributing films, often investing hundreds of millions. They claim these fees and allocations cover operational costs, recoup investments, and account for the many films that genuinely lose money. They emphasize protecting corporate profitability given fluctuating success rates. However, critics argue this defense often serves as a smokescreen for a predatory system designed to minimize payouts to profit participants, concentrating wealth and power within the studio's corporate structure, leading to widespread frustration and distrust among talent. But what happens when the veil is lifted? What happens when internal documents, shielded from public scrutiny, suddenly surface, exposing the intricate details of these financial maneuvers? That's precisely what has begun to unfold, sending shockwaves through the industry. These leaked documents offer an unprecedented, unfiltered look into the actual financial breakdowns of some of Hollywood's biggest blockbusters. They lay bare the precise figures, specific charges, and internal justifications that allowed studios to declare monumental successes as financial losses. This isn't theoretical speculation, it's concrete evidence, illuminating mechanisms that kept artists from their rightful earnings. The scale of what these documents reveal is truly astounding, painting a picture of a system far more pervasive and meticulously engineered than many outside the inner circles had ever imagined. We are only just beginning to scratch the surface of what these documents mean for the future of filmmaking and talent compensation, and the full story promises to be even more intricate. The leaked documents offer granular breakdowns of budgets, expenditures, and revenue allocations, painting a stark picture. For instance, one set details how a film grossing over $500 million worldwide was declared to have lost tens of millions. The papers meticulously outline a labyrinth of internal charges, a 15% distribution fee taken off gross receipts, followed by a 20% overhead charge on the production budget, even after delivery. Crucially, these documents show marketing recoupment line items far exceeding actual documented advertising spend for that specific picture, suggesting a pooling of marketing costs across multiple projects and disproportionately assigning them to the most successful ones. These aggregated charges systematically eroded any potential for net profit. The documents reveal how a studio's own visual effects division billed the film at rates significantly higher than external vendors, effectively transferring profits internally while inflating reported costs. The paper trail details these transactions, including intercompany invoices and internal memos discussing profit center optimization, a corporate euphemism for shifting funds to benefit the parent company at the individual film's expense. The conflict is stark. Studios maintain these charges are legitimate business expenses, crucial for operational continuity and risk mitigation. But the leaks suggest a more strategic, almost surgical application of fees, designed not just to cover costs, but to actively prevent films from reaching paper profitability, thereby avoiding profit participation payouts. This isn't about covering legitimate expenses, it's about defining legitimate in a way that serves only one party. A particularly damning revelation involves interest on production loans. Studios often finance films internally, and leaked documents show individual productions charged significantly higher interest rates than market rates. This internal loan sharking further siphons off potential profits, creating another layer of expenses that almost guarantee a paper loss. It's a closed system where the studio acts as bank, distributor, vendor, and accountant, each role designed to extract maximum value before any net profit can be calculated. These documents now fuel a renewed wave of legal challenges. Attorneys representing artists and production companies pore over these figures, finding concrete evidence to support claims previously dismissed as speculative. The sheer volume and specificity of the data provide an undeniable evidentiary basis, shifting the burden of proof and forcing studios to explain specific discrepancies rather than hiding behind general accounting principles. The immediate fallout is palpable tension within Hollywood. Talent agencies reportedly advise clients to scrutinize contracts more closely, demanding clearer net profit definitions or pushing for gross participation deals, which are less susceptible to studio accounting tricks. However, the power dynamic remains skewed. For emerging artists or those without significant leverage, gross participation demands are often non-existent, leaving them vulnerable to the system these documents expose. This escalating conflict isn't just about money, it's about trust, transparency, and the fundamental fairness of creative partnerships. When a director pours years into a project, delivers a global phenomenon, and is then told it lost money, it breeds resentment and discourages future collaborations. The leaked documents validate these long-held suspicions and frustrations, transforming anecdotal grievances into documented systemic abuses. What do you think about these revelations? Have you ever suspected something like this was happening behind the scenes in Hollywood? Share your thoughts and theories in the comments below, and let us know which other industry secrets you'd like us to investigate. Your insights are invaluable. The impact extends beyond individual artists. Independent production companies, often relying on studio distribution and financing, find themselves trapped in a similar web. They might secure a deal, only to see their box office success vanish into the studio's accounting black hole. The leaked documents expose how these smaller entities are often squeezed first, their potential earnings absorbed by the larger corporate machine. This stifles independent filmmaking and consolidates power further into the hands of a few major players. Public perception of Hollywood is also at stake. For decades, the industry projected an image of glamour and boundless success. These leaks, however, peel back that glittering facade to reveal a deeply cynical, self-serving financial apparatus. It raises questions about the ethical foundations of an industry that relies so heavily on creative talent but seems intent on denying them their fair share. This isn't just a business dispute, it's a moral quandary touching upon artistic integrity and fair compensation. Studios, facing unprecedented scrutiny, are in a precarious position. Their usual defenses, inherent risks, high costs, corporate profitability, are directly challenged by their own internal records. While they may argue the legality, the ethics are undeniably in question. The documents don't just show what happened, they often reveal why it happened, exposing internal strategies aimed at profit retention over equitable distribution. The long-term implications are still unfolding. Will these leaks lead to significant legislative changes, pushing for greater transparency in film accounting? Will talent unions gain more leverage in negotiations, demanding stricter contractual clauses? Or will Hollywood simply adapt, finding new, more opaque ways to achieve the same financial outcomes? What is clear is that the genie is out of the bottle. Studios can no longer completely control the narrative around their financial practices. The conflict is not resolved, it is merely intensified, shifting from whispers and accusations to documented evidence and undeniable facts. The battle for transparency and fair compensation in Hollywood has just begun, and these leaked documents are proving to be the most powerful weapon yet for those seeking change. The legal arena has become the primary battleground, with the leaked documents serving as the most potent ammunition for aggrieved artists. One particularly high-profile case involves a celebrated director responsible for a beloved sci-fi franchise that grossed billions globally. For years, this director, along with key cast members, had been told their films, despite their immense cultural and financial impact, had never reached net profit. Their lawsuits, once seen as long shots against the studio's formidable legal departments, have now gained unprecedented traction. The leaked spreadsheets, internal memos, and audit reports meticulously detail how the studio systematically applied a 15% distribution fee on gross receipts, a 25% overhead charge on the production budget, and then an additional 10% interest rate on internal loans, far exceeding market averages. These figures, previously hidden behind layers of corporate secrecy, now stand as irrefutable proof. Attorneys for the director have presented evidence showing how the studio's internal visual effects company charged the production 30% more than quotes from external, equally reputable vendors, effectively transferring millions from the film's balance sheet to another subsidiary of the same parent company. This isn't just about questionable accounting, it's about a clear pattern of self-dealing, designed to zero out any potential profit participation obligations. The very definition of net profit is being challenged in court, with lawyers arguing that the studio's interpretation renders the contractual term meaningless from the outset, thus constituting a breach of contract and, potentially, fraudulent misrepresentation. Studios, naturally, are not taking these challenges lying down. Their legal teams have launched aggressive counter-strategies. Publicly, they reiterate their long-standing arguments about the inherent risks of filmmaking, the vast capital investments required, and the need for robust financial structures to ensure corporate viability. They emphasize that a significant percentage of films genuinely do lose money, and that the fees and charges are legitimate mechanisms to recoup investments and cover operational costs. Privately, however, the tone is shifting. There are reports of internal directives to tighten security around financial data, and a renewed push to identify the sources of the leaks, hinting at severe consequences for any whistleblowers. Some studios are attempting to discredit the leaked documents themselves, alleging they are incomplete, taken out of context, or even fabricated, though the sheer volume and consistency of the data makes such claims difficult to sustain. The narrative they are desperately trying to control is that these are complex business practices, misunderstood by outsiders, rather than predatory schemes. They are also subtly leveraging their immense power, reminding agents and talent that challenging the system too aggressively could lead to blacklisting or diminished opportunities in a highly competitive industry. This creates a chilling effect, particularly for those whose careers are not yet fully established. The struggle over gross participation deals versus net profit remains central. While the leaked documents validate the long-held suspicions about net profit accounting, securing a gross participation deal, where an artist gets a percentage of a film's gross revenue before most expenses, remains an exclusive privilege for only the most bankable stars and directors. Even for them, these deals are hard-won and often come with significant trade-offs, such as a lower upfront salary. For the vast majority of creatives, from screenwriters to cinematographers, the dream of back-end profits remains tied to the elusive net profit definition. Talent agencies, emboldened by the leaks, are pushing harder than ever for clearer, more transparent accounting clauses in contracts. They demand independent audits, caps on specific fees, and standardized definitions of overhead and distribution costs. However, studios resist fiercely, arguing that these demands would cripple their financial flexibility and ability to manage risk. The power imbalance is stark. A studio can walk away from a deal with a mid-tier talent, knowing there are hundreds of others eager for the opportunity. This leaves many artists in a precarious position, forced to choose between accepting unfavorable terms or foregoing potentially career-making projects. The increasing visibility of these revelations has also caught the attention of federal regulators and lawmakers. Reports indicate that the Department of Justice, prompted by concerns over potential anti-competitive practices and consumer fraud, as inflated costs could theoretically be passed to consumers, and investors are certainly impacted, has begun preliminary inquiries. Congressional committees are reportedly considering hearings to investigate the opaque financial practices of major Hollywood studios. The industry, accustomed to self-regulation and operating largely outside direct government oversight on financial matters, is now facing the unprecedented specter of federal intervention. This could lead to a demand for greater financial transparency, potentially even standardized accounting practices for film productions, similar to those in other publicly traded sectors. Such a move would be revolutionary, dismantling decades of entrenched, self-serving accounting methods. The studios are, of course, mobilizing their formidable lobbying apparatus to argue against any governmental interference, framing it as an attack on creative freedom and economic innovation, but the political pressure is mounting. The ripple effects extend beyond the immediate studio talent conflict. Independent production companies, often relying on major studios for distribution and marketing, are finding their own financial futures jeopardized. Many have signed agreements mirroring the profit participation clauses offered to individual creatives, only to see their successful films similarly declared unprofitable. The leaked documents expose how these smaller entities are often the first to be squeezed, their potential earnings absorbed by the larger corporate machine through the same mechanisms of inflated fees and intercompany charges. This stifles independent filmmaking, making it harder for innovative projects to secure funding and thrive, further consolidating power into the hands of a few major players. The ethical debate rages not just within Hollywood, but also in broader media discourse. Major news outlets, once content to report on box office numbers, are now delving into the intricate financial mechanics, questioning the integrity of an industry that so heavily relies on creative talent yet seems intent on denying them their fair share. This isn't merely a business dispute, it's a moral quandary touching upon artistic integrity, fair compensation, and the very structure of creative industries. The internal dynamics within studios are also reportedly under strain. While management presents a united front, whispers of discontent among mid-level executives and financial personnel are emerging. Some are reportedly concerned about the long-term reputational damage and the potential for regulatory fines. The culture of secrecy, once a shield, is now a liability. The possibility of further leaks, perhaps from disgruntled employees or those genuinely disturbed by the ethical implications, looms large. Each new revelation only deepens the crisis of trust. The battle for control over information is as fierce as the legal battles in courtrooms. Studios are investing heavily in digital forensics and internal investigations to plug the leaks, but the information, once out, cannot be entirely contained. The narrative is no longer solely theirs to shape. This unprecedented transparency is forcing an industry built on illusion to confront its underlying financial realities, and the consequences are far from fully realized. The implications for future film financing models, talent contracts, and even the public perception of cinematic art are profound and still evolving. The stage is set for a prolonged and transformative conflict. The legal arena, once a labyrinth studios expertly navigated, was fundamentally reshaped by the irrefutable evidence of the leaked documents. The celebrated director of the multi-billion-dollar sci-fi franchise, armed with meticulous spreadsheets and internal memos, pressed forward with their lawsuit. The studio, facing not just a potential financial judgment but an unprecedented public relations nightmare, found its usual defenses crumbling. The detailed evidence of self-dealing, the inflated VFX charges, the exorbitant internal loan rates, the disproportionate marketing recoupment, left little room for ambiguity. After months of intense legal maneuvers, a landmark settlement was reached. While the exact figures remain confidential, industry insiders reported it was a monumental sum, not only compensating the director and key cast members for past grievances but also establishing new, more transparent profit participation clauses for their future projects. This wasn't merely a payout, it was a concession, a tacit admission of the systemic flaws the leaks had exposed. This victory sent a seismic shockwave through Hollywood. Other aggrieved artists, emboldened by the precedent, saw their own stalled lawsuits gain immediate traction. Production companies, previously resigned to their fate, revisited their contracts. Studios, recognizing the shift in the legal landscape, quietly began to settle numerous cases out of court, opting for damage control over prolonged, publicly damaging battles. The days of dismissing profit participation claims as speculative or unprovable were definitively over. The burden of proof had shifted, and studios could no longer hide behind opaque accounting principles. Simultaneously, the whispers of federal intervention escalated into a roaring chorus. The Department of Justice, now with concrete evidence of potential anti-competitive practices and investor fraud, launched formal investigations. Congressional committees, responding to public outcry and the sheer volume of documented abuses, convened high-profile hearings. Industry executives, often accustomed to operating in the shadows, were compelled to testify under oath, their usual evasiveness challenged by pointed questions and the undeniable facts presented by whistleblowers and financial experts. The narrative of complex business practices misunderstood by outsiders dissolved under the weight of detailed, internal corporate communications outlining strategies for profit center optimization, a term now synonymous with profit diversion. The result was a monumental legislative push. After months of intense debate and fierce lobbying from studios, a bipartisan Film Industry Transparency and Accountability Act began to take shape. This proposed legislation aimed to mandate standardized accounting practices for film productions, requiring independent, third-party audits for any project with profit participation clauses. Crucially, it sought to establish clearer, less manipulable definitions of net profits, set caps on internal distribution and overhead fees, and regulate intercompany charges to prevent self-dealing at inflated rates. It also proposed stricter penalties for financial misrepresentation, turning what was once a contractual dispute into a matter of federal regulatory oversight. This was a direct challenge to decades of studio autonomy, threatening to fundamentally restructure the financial backbone of the entertainment industry. Studios, while deploying their formidable lobbying apparatus to soften the blow, found themselves on the defensive. Their traditional arguments about inherent risks and the need for financial flexibility now rang hollow against the backdrop of documented manipulation. Some major studios, anticipating the inevitable, began to proactively adjust their internal accounting policies, seeking to demonstrate a commitment to reform and mitigate future legal and regulatory risks. Financial departments underwent significant restructuring, and internal controls were tightened, not to prevent leaks, but to ensure compliance with what was clearly an impending new era of scrutiny. The era of unchecked financial discretion was undeniably drawing to a close. The shift in power dynamics across Hollywood was palpable. Talent agencies, now armed with irrefutable evidence and the backing of potential federal legislation, negotiated with unprecedented leverage. While gross participation deals remained the exclusive domain of a select few superstars, their terms became more favorable, and hybrid models emerged, offering a percentage of gross revenue after specific, clearly defined, and capped expenses. For the broader spectrum of creatives, screenwriters, cinematographers, mid-tier actors, and directors, contracts began to include clauses for independent audits, transparent expense reports, and definitions of net profit that were far less susceptible to studio manipulation. The art of the deal was no longer solely about upfront compensation, it was about ensuring equitable back-end participation, a promise now backed by legal and regulatory teeth. Independent production companies, long the silent victims of Hollywood accounting, found a new lifeline. With clearer contractual protections and the threat of federal oversight, they could now negotiate more equitable distribution and financing deals. The fear of their box office success vanishing into a studio's accounting black hole began to recede. This promised to foster a more diverse and vibrant filmmaking landscape, allowing smaller, innovative projects to thrive without being financially cannibalized by larger corporate entities. The public perception of Hollywood also underwent a significant transformation. The glittering facade of glamour and boundless success, once a powerful draw, was now tempered by a widespread understanding of the industry's cynical financial underbelly. While the magic of cinema itself remained, the business behind it was seen through a new lens of skepticism and demand for accountability. This ethical reckoning forced the industry to confront its responsibility to the creative talent it relied upon, questioning whether artistic integrity could truly flourish in a system designed to deny its creators their fair share. The internal dynamics within studios continued to be strained. While management presented a united front externally, internal reports indicated a heightened sense of caution and a palpable shift in corporate culture. The threat of further leaks, now from employees empowered by the changing landscape, loomed large. The battle for control over financial information had been lost, and the narrative was no longer solely theirs to shape. The implications for future film financing models, talent contracts, and even the public perception of cinematic art were profound and still evolving. The stage was set for a prolonged, but ultimately transformative, conflict. The battle for transparency and fair compensation in Hollywood has not ended, but a critical, undeniable turning point has been reached. The leaked documents were not just a scandal, they were a catalyst, tearing down decades of financial obfuscation and forcing an industry built on illusion to confront its underlying realities. The era of unquestioned studio dominance in financial matters is over, replaced by a new landscape where accountability, transparency, and fairness are increasingly demanded, and, for the first time, enforceable. The ultimate balance of power in Hollywood is still being negotiated, but one thing is clear, the curtain has been pulled back, and the show of financial wizardry can no longer continue unchecked. If you found this deep dive into Hollywood's intricate financial secrets enlightening, make sure to subscribe to our channel for more investigative content that pulls back the curtain on hidden truths. Hit the like button to support our work and help us bring more stories like this to light, and share your thoughts in the comments below. What other industry secrets would you like us to uncover next?